Welcome to Uncommon Sense, where ordinary financial wisdom just doesn't cut it. Follow along with Eric Bowman as he provides clarity in a cluttered financial world.
Hey everybody, Eric Bowman here from Bowman Financial Strategies. Welcome to the Uncommon Sense podcast. We got Ben George with us today. How are you doing, Ben?
I'm doing great today, Eric. Good to see you.
Good to see you too. So today, what we're going to talk about tax efficiency in retirement, try to unpack that and understand, you hear that all the time, right? I don't know if you've received any, invitations in the mail to go to a retirement seminar and it says tax efficiency in retirement. It's like, what does that even mean? I think that there's a lot for us to digest, but then I think it actually begs the question, why do we even care? Like, what do we care about tax efficiency in retirement? What's the risk if we're not tax efficient in retirement? So why don't we kind of dig into that a little bit, Ben?
Yeah, I'm curious because I know when I think taxes, and a lot of people think taxes, well, what I owe next April, right? That's kind of the first thing that comes to mind. And you think way down the road, well, I still have 20 years, 10 years, 15 years, whatever that number is, until retirement. I can figure out some of those tax strategies when I get a little bit closer. But I think, as you'll point out, it matters now, doesn't it?
Yeah, the earlier you start planning for almost anything, the better off the execution of the event's going to be. So likewise with retirement planning, it doesn't mean, though, that we can't put in effective planning during that transition into retirement. There's actually some reasons why things like Roth conversions, and we can chat a little bit about that, of why they may work better, frankly, right when you're transitioning into that distribution phase or the retirement phase. But bottom line is anything you can do ahead of time to prep the playing field to make yourself more tax efficient is going to benefit you down the road.
All right, well, let's just point out then to start off before we get into the different account types and how to become tax efficient. Why does this even matter right now?
Yeah, good question. So we have a slide here that we can talk about. This is looking at federal tax receipts and expenditures from the United States federal government in the calendar year, or the fiscal year rather, 2023. So let's take a brief look at this. So in 2023, the federal government received $4.4 trillion in tax receipts. So that was the money that came into the government from hardworking Americans and companies and everybody else. Of that 4.4 trillion, 3.8 trillion went to mandatory spending. What is mandatory spending? Let me name a few. Okay. Social Security and Medicare. Two of the biggest sources of mandatory spending out there. On top of that, 0.6 trillion went to funding the debt. So that's the interest on the existing debt is 0.6 trillion. In the year 2023, for the first time ever, that 0.6 trillion exceeds military spending. So what I mean is we are now officially living the world that everybody worried about a decade ago. They said, oh my gosh, you better be careful because one day in the future, if we keep on incurring this debt, we're going to pay more on interest than we do on the military. And it's finally happened. It's here today. We pay more in interest on the debt than we do to fund the entire United States military on an annual basis. Now, in addition to that, 1.7 trillion on discretionary spending. Military is part of that discretionary spending. So what you really see, and that's every other government program built into that, military and other things. So what it really means is, other than mandatory spending and net interest payments on the debt, every other government program must be funded with deficit spending, meaning they're selling bonds and they're increasing the debt load of the United States. So if we go to that next slide, let's wonder, how much is our current debt? In 2023, the full debt of the United States was over $34 trillion, growing by about $2 trillion a year, right? So what does that mean? How do you pay that down if anybody ever thinks they're going to do it? There's only one way, and that would be to increase revenues. And how does the government increase revenues? By growth or taxes that are higher, or both.
Yeah. And I know there's a lot of conversation about taxes right now. We're in the middle of an election season. I know we've heard Harris's campaign is centered around a lot of taxes have come out. I know capital gains taxes have been discussed. I know the Trump tax cuts will sunset here soon. So either way, something's probably going to give in the near future too.
Yeah, great observations. I mean, you're hearing everything from taxing unrealized capital gains. If you don't know what unrealized, it's super scary, right? You own something, it grows in value. You haven't sold it. you don't have any financial benefit from it, and they want to tax the capital gain without you having sold it. We don't know exactly what it looks like, who the target is exactly, but just that idea is a slippery slope that one day is going to probably waterfall down to the average American if they ever get that over the hump and actually start taxing unrealized gains. That's like taxing unrealized income, because capital gains are a form of income. How about if they taxed you on next year's income before you even received it? You'd lose your mind if they did that, right? And then to your point, the current 2017 Tax Cuts and Jobs Act, which is the tax regime we live in now, the marginal tax brackets, this really awesome standard deduction that's huge. I mean, it's over $30,000 a year for a married couple, married filing jointly in their mid-60s. And it's a great thing to be able to deduct that much and not pay taxes on that first, standard deduction of income. Well, all that goes by the wayside January 1st, 2026. It just disappears. We revert back to the previous administration's tax laws, which means the standard deduction gets cut in half. There's more tax brackets, and on average, everybody's taxes will increase if their income were to stay exactly the same, if they do indeed revert back to the old tax rules.
Yeah, and that's not even talking about what we've went over in a recent video on Social Security and how taxes might have to increase just to help keep that afloat and keep the benefits at full capacity, right? So there's a lot being talked about right now. So, if you don't think taxes affect you right now for your retirement, it's clear that even if they don't move at all, it's better to be err on the side of caution, right, than to worry about, hopefully the government doesn't change anything.
That's why I love having you here. That's actually a great point, Ben. This err on the side of caution. What we want to do is prepare our clients for something called legislative risk, the risk that the rules will change and they will be a detriment to you. So if you prepare appropriately, you reduce your exposure to that legislative risk, meaning the chance that Congress is going to increase taxes and it's going to negatively impact you. But if you do certain things now, you can avoid that legislative risk, or at least reduce your exposure to that legislative risk. And if for some reason they end up not raising taxes, well, those tactics you put in place are simply going to help you be more tax efficient under the current structure. It's good for you either way to think about taxes. One thing I've heard before is, did you know that your IRA is an IOU to the IRS, right? The government knows that there's trillions of dollars sitting in 401ks and IRAs, and they're going like this, saying, wow, we're going to get some taxes from that. Let's figure out what type of legislation we might be able to put in place to ensure we maximize the taxes. And they've made changes already, like the changes to inherited IRAs that we've done a previous podcast on. The changes to inherited IRAs are crazy, and they ensure that the government will get more taxes. But if you change the taxability of your account types, and that's probably a good segue, is how do we actually lay the playing field out in such a way that we can pay less taxes than maybe a peer of ours that has the exact same type of income from Social Security, and they have the same amount of assets saved, but they might not have repositioned those assets appropriately.
Yeah, that's a good point, because I've never actually heard legislative risk before, but it's spot on, and it makes perfect sense why you have to prepare yourself for that. The good news is that you don't have to just kind of wait and just let it happen, right? You can get ahead of these things and be tax efficient. So what are some of the strategies you guys utilize at Bowman to help someone become more tax efficient with their retirement portfolio?
Yep. So right on target there. I think step one, if you could, let's pull up that slide where we look at the different types of accounts. So this gives you like a brief breakdown of the different types of accounts that are available out there. If you in the upper left corner, the blueberries there, you see IRAs, 401ks, and 403bs. Those accounts are all taxed identically. And what I mean by that is traditionally you're going to put your money in pre-tax. So it's called elective deferral. I elect to defer my income until retirement, so I don't want to pay ordinary income tax on my contributions into my 401k or my IRA. That's the way those work at the contribution phase. Then there's the growth phase. So the second of three phases is when it grows, it's tax deferred. So inside of a 401k or an IRA, you pay no taxes. You could buy and sell all day long, accrue growth, but never pay taxes on that growth while the money resides in the IRA. Then when you distribute, 100% of the distributions are taxed as ordinary income. All of it. You have no choice. So that's an example of one account type and the three phases. Let me focus on the other account types here too, but let me just look at the third phase when you're taking your money out, most important to retirees. So a Roth IRA, by contrast, when you take your money out of that account, you have no taxation as long as you follow the 5-year rules. There's a couple of rules you have to follow, but if you follow the rules, no taxation at distribution. That's fantastic. Social Security, a really oddball income stream. It's a very complex calculation they use to determine how much is taxed. But if you know their formula, it's called the provisional income calculation, you can actually control how much of your Social Security is taxed. Brokerage accounts. So let's say you've got some money in the bank, you open up an account at Schwab, you take some of your bank account money and you put it in there and you buy some Home Depot stock. That's called a non-retirement brokerage account, subject to capital gains. 2 types, long-term and short-term. If you buy Home Depot stock, for example, for $1,000 and you let it grow to $2,000, but you sell it within 9 months, let's say, less than 1 year, you have incurred a $1,000 short-term capital gain. Bought it for $1,000, it grew to $2,000, the $1,000 of growth because I sold it in less than a year. Short-term capital gain taxed as ordinary income, not capital gain income. The next would be you buy Home Depot for $1,000, it grows to $2,000, but you don't sell it until over a year goes by. So let's say it's 2 years down the road, you sell it, you made that $1,000. Now it's called a long-term capital gain, subject to a completely different, although connected, very complicated situation here, but a completely different tax bracket called long-term capital gains tax brackets. There are benefits, though, to having this type of money that I'll get to in a moment. The third, or not third, but the next account type, HSA, that's health savings account. It is admittedly or arguably the most tax efficient account available in the United States. Let's think about this for a second. When you put your money in, you pay no taxes. When you let your money grow, if you invest it, you pay no taxes. And so long as you use it for qualified healthcare expenses, you pay no taxes. So one could argue that you would want to put a bunch of money in there within the limits and constraints on an annual basis and never use it and let it grow tax-free and become this huge bucket of tax-free money. Because when I'm in my 60s, I think there's a good chance I might have health issues and I could have qualified healthcare expenses. And I'd love to have a tax-free bucket to join or to draw from. So that's what I do in my household. We have these HSAs. We never touch them. We just contribute, let it grow tax-free, and then one day I'll use it tax-free in the future. So what we see is there's a lot of different types of accounts, and at that distribution phase, a lot of different types of taxability.
Well, I like that the no tax is represented by a cupcake in the picture. It's a nice dessert to chew on there. With the HSA though, is what is the penalty if you do need to pull it out ahead of time? Is it just a standard penalty like it would be for most of these other accounts?
No, there could be penalties, excise taxes. You don't want to do that. I mean, you want to use it you can use it for qualified healthcare expenses even when you're in your 50s or 40s. There's not an age constraint there. There's a utilization constraint. What do you use it for? That's the primary thing. Even there's another rule that says once you hit age 65, you can actually use the HSA for non-medical costs. However, it will be fully taxed just like an IRA, not a penalty, but taxed. If you're younger than 65 and you don't use it for medical expenses, then you'd pay tax and penalties. So not something you'd ever want to get involved in there.
Social Security planning can be complex, but you don't have to navigate it alone. Visit our one-stop Social Security resource at bowmanfinancialstrategies.com. Discover detailed videos, downloadable PDF guides, and the latest updates from the Social Security Administration. Don't let Social Security questions hold you back. Click the link in the show description and bring Social Security into focus.
All right then, Eric. So how do you at BFS help people? Because I look at this and I go, well, this is a lot to try to figure out where I need to put my money. I've got a lot of different options. So how do you help someone become more organized, determine what they need to put in each of these buckets?
Right. Let's simplify. Step one, we have to evaluate what you have now and what your income is. So most people, not everybody, will have the majority, if not all of their money in 401ks. Fully taxable at distribution. They're like, I don't have any Roths. And if they do, it's just a couple $1,000, right? It's not going to be meaningful. What's interesting is Once you retire, or maybe it's that year of retirement, you work half a year and then you only have half the income for a year, you will have less taxable income in that year, and therefore you will be in lower tax brackets. That could be a fantastic year to do Roth conversions, which is the movement of money from a 401k or an IRA. Typically, you go into an IRA and then do the conversion into a Roth. You're going to have to pay ordinary income tax on the amount that you convert over to the Roth, but you can do it over a couple of years in a row. Let's say a 5-year Roth conversion plan, moving a slice of the IRA over each year so you don't get what I call tax bracket creep, meaning you're continually moving up, paying higher and higher percentage of taxes. If you moderate the amount you do each year, you can moderate the taxes paid and still build up a meaningful Roth account. You know, the most simple way of evaluating this, though, is if you want to be tax efficient in retirement, you need to have these different types of accounts. I love it when I see a client come in with IRA money, Roth money, and non-retirement money, those joint tenant accounts or an individual brokerage account that are non-retirement, subject to capital gains. When you have those three types, you are sitting now on this treasure trove and ability to make distributions on an as-needed basis from those different accounts in such a way that you get the money you need, but you pay less taxes than somebody who is simply forced to draw it only from an IRA. So simplified once again, we want a diversity of account types by taxability. We can create those by doing Roth conversions in lower tax brackets in the year and the years just after retirement in many cases. And at any given time, it makes sense, in my opinion, that you should be taking any excess cash flow that you have and building up your non-retirement brokerage account, whether it's $200, $500, $1,000 a month. Start building that early, save often, and save consistently, make it automatic. And then one day you're going to open your eyes and go, holy cow, I've got a meaningful amount in each one of these types of accounts. Now you're sitting in a really good position to manage your taxes in retirement.
Well, I know you said you'd like to see somebody that comes in and already is diversified, to a certain extent. Even if you're not, though, right, that you can still come in and get those things sorted out by working with you.
Yeah, we do what's called a Roth conversion analysis. We determine if we can now do them, even if you haven't. And that's actually the most common outcome, is we end up doing Roth conversions for our clients when they come in and we start planning for retirement, or if they're even in the year of retiring. So it's not too late to do that. And you simply call up the office or go to our website and click on a button to calendar some time. We'll have a brief 15-minute call, understand what your goals and concerns are, see if I can help. And if it looks like I can help, then we'll go ahead and come together on what the engagement process would look like from there, which typically involves creating a full retirement plan covering all aspects of your retirement needs.
Well, all those links will be in the show notes, the description there. So phone number, website as well to schedule that consultation. But I know, Eric, this is not something we like to think about. Taxes. It's not exciting, but you see some of those slides, see some of the numbers dealing with debt, and it makes you realize that, hey, I need to do as much as I can now to help not foot that bill down the road.
Yeah. And just one closing remark is anything you do that helps you in retirement, if you have children, it helps them, because tax-free money in Roths, so growing tax-free and distributions tax-free, are also under current law tax-free to children when they inherit it, unlike the inherited IRAs. So just keep in mind, it can actually have an intergenerational tax benefit, and so should be really considered.
Yeah, that's a great point, and that's important to so many people. So thanks for taking us through this, Eric. It's definitely eye-opening to see those numbers, but I know that it's important to kind of understand that structure, and I've got a better sense of that today.
Yeah, well, I thank everybody for watching Uncommon Sense today. My name's Eric Bowman. I want to thank Ben George for being with me and keeping us on track. Please reach out if there's anything we can do for you. Thanks for your time.